Are you doing okay? Are you feeling secure about your retirement income, or are you secretly terrified that the volatile stock market is going to chew up your life savings and leave you with nothing? Listen to me. If you are approaching retirement, or if you are already there, the game has fundamentally changed for you. You no longer have the luxury of waiting 10 or 20 years for the market to recover from a crash. You need cash flow, and you need it right now to pay for your groceries, your medical bills, and your life. But here is the big question I get asked every single day: Susie, how do I actually generate safe income without risking my principal in dangerous investments? Many of you turn to dividend exchange-traded funds, or ETFs, thinking they are a magical, safe cure-all. You see a high yield and you think, perfect, my problems are solved. No, they are not. If you buy the wrong dividend ETF out of fear or out of greed just because you want a big paycheck, you could be walking directly into a trap. Not all dividend ETFs are created equal. Some protect your money, while others expose you to massive sector crashes or companies that are fundamentally broken. Today, we are going to look at the top 5 dividend ETFs on the market: SCHD, VYM, VIG, DGRO, and JEPI. I am going to compare them directly so you know exactly which one fits your life, because look at me, you cannot afford to make a mistake with your retirement money. Let's start with the Schwab US Dividend Equity ETF, ticker symbol SCHD. This fund has become an absolute darling for income investors, and for good reason. It tracks the Dow Jones US Dividend 100 Index. What I love about SCHD is that it doesn't just chase the highest yielding, riskiest stocks out there. It uses a strict quality filter. It looks for companies that have paid dividends for at least 10 consecutive years, and then it evaluates them based on cash flow, debt, and dividend growth. It gives you a great balance of a strong current yield, usually sitting right around 3.3% to 4%, and incredible dividend growth. But you must understand the catch with SCHD. Because of its quality filters, it is heavily weighted in financials, industrials, and consumer staples. It holds almost no technology stocks. That means when tech stocks are booming, SCHD will lag behind the broader market. If you are someone who panics because your fund isn't keeping up with the S&P 500 during a tech rally, SCHD might make you nervous. But if you want a rock-solid core fund that focuses on financial health and consistent raises, this is a beautiful place to look. Now, let's look at the second contender, the Vanguard High Dividend Yield ETF, ticker symbol VYM. This fund takes a completely different approach. VYM tracks the FTSE High Dividend Yield Index, which simply looks at U.S. companies that pay higher than average yields and bundles them together. It holds over 600 stocks, making it incredibly diversified. VIG is a completely different animal. It doesn't look for high yield at all. In fact, its current yield is quite low, usually around 1.6% to 2%. I know what you are thinking, Susie, why on earth would I invest in a dividend fund with a low yield for retirement? Because VIG requires companies to have increased their regular dividend payments for at least 10 consecutive years, and it completely eliminates the top 25% highest yielding stocks. Why? Because often, an exceptionally high yield is a sign of a distressed company in trouble. VIG focuses purely on financial aristocrats, well-managed, shareholder-friendly companies that have the cash to give you a pay raise every single year. Because it weeds out the high-yield traps, it actually holds a significant amount of technology and high-quality growth stocks. VIG is not for current maximum income. VIG is for the person who wants total return and wants their income to grow faster than inflation over time. It is a defensive shield for your portfolio. Our fourth fund is the iShares Core Dividend Growth ETF, ticker symbol DGRO. This fund sits right in the sweet spot between SCHD and VIG. DGRO requires companies to have at least 5 years of consecutive dividend growth, and it requires a sustainable payout ratio. That means the companies cannot be paying out more than 75% of their earnings as dividends. They must keep money to reinvest in their own businesses. Here is the truth you need to swallow about JEPI. When the markets are flat or falling, JEPI is a superstar because those options premiums protect you and keep paying you. But when the market rallies, your upside is strictly capped. You will completely miss out on major bull markets. More importantly, those high double-digit payouts are not guaranteed. They fluctuate every single month based on market volatility. If the market quietens down, your income drops. JEPI is an income tool, not a growth tool. If you are older, if you have a smaller nest egg, and you absolutely must extract maximum cash from your portfolio right now to survive, JEPI can serve a purpose. But do not put all your money there. It has very little capital appreciation, and over the long term, its total return can lag significantly behind funds like SCHD or VIG. So, how do you take action today? How do you choose? First, look at your current financial situation. If you need maximum steady income today with great historical growth, you look at SCHD as your core anchor. If you want ultimate diversification across the entire U.S. economy and you don't want to worry about a few companies ruining your retirement, you blend in VYM. If you are early in retirement and your biggest fear is that your money won't last 20 or 30 years against inflation, you prioritize VIG or DGRO for that powerful dividend growth and capital appreciation. And if you are truly strapped for cash today and need immediate high yield, you use JEPI defensively, but only as a smaller piece of your overall puzzle. Do not let fear dictate your investments, and do not let greed blind you to the underlying risks of these funds. Look at the expense ratios. Thankfully, funds like SCHD, VYM, VIG, and DGRO are incredibly cheap, costing you almost nothing to own, around 0.04% to 0.08%. JEPI is a bit more expensive at 0.35%, which makes sense because it is actively managed. Your actionable takeaway today is to look at your asset allocation. Stop chasing raw yield. Look at what is inside the fund. Choose the ETF that matches your specific phase of retirement. Be safe, be smart, and secure your income the right way.